In this video, I'm going to walk you through exactly how I would approach starting my day trading journey from absolute zero if I had to begin all over again today. And before reaching a level where I've developed a complete system and structured my trading to consistently hit $5,000, sometimes even $10,000 to $20,000 profit days, I honestly threw away years of my life with thousands of hours of confusion and also several hundreds of thousands of dollars that I absolutely did not need to lose if I had understood the core principles and foundation that I'm about to break down for you in this video. So I'm going to begin with the fundamental concepts, giving you a straightforward approach to viewing the markets and starting with the absolute basics. Then I'm going to walk you through the platforms and resources that you're going to need to implement this entire process. I'm going to dive deep into trading psychology, which is hands down the most critical factor that will either launch your success or completely sabotage your trading. A clear explanation of what your actual trading goals should be that often confuses newcomers, plus a comprehensive breakdown of the essential technical analysis concepts that actually matter. After that, I'm going to demonstrate how to construct and validate your own trading strategies using my own personal trading methodology that's delivered an 81% success rate and made me millions of dollars in the financial markets over the last 6 years. Finally, I'm going to show you how we can combine everything we've covered and put them to work in an actual market scenario so you can see these concepts functioning in real time. So once you've worked through this complete video, you're going to walk away with a crystal clear, streamlined roadmap for launching your trading career the right way from day one, which will give you the best possible chance at being profitable in this space. All right, so let's begin by establishing the groundwork and really understanding what's happening in the markets and how we should be approaching price movement. There are tons of complex technical concepts that can be incredibly overwhelming, and if you pick up random pieces of information, it can completely derail your progress. This is the most straightforward way to grasp how markets function and the underlying mechanics that drive everything. So right here, I've got a chart pulled up, but for now, we're not going to focus on anything except understanding how and why price actually moves. When we're examining any chart, all we're observing are increases and decreases in the value. So essentially, the chart is giving us a visual display of collective human behavior, which means there are people buying and people selling. Now, this happens through things like algorithmic trading, manual human emotion, institutional flows, and various other methods. So it's definitely more complex than individuals simply hitting buy and sell buttons, but the core concept is that the market is constantly adjusting to balance out disparities created by supply and demand forces. So here's how this actually works. Let's examine this section right here. For instance, during this portion of the chart where price is climbing higher, that indicates there's buying pressure from purchasers and selling pressure from sellers. When the buying pressure exceeds the selling pressure, the market will continue rising until we reach another point where selling pressure begins to overpower the buying pressure. And the market will pull back until once again, buying pressure begins to dominate. This creates a constant back and forth dynamic which generates what we call volatility. Volatility essentially refers to any dramatic, significant price movements in the market, and these create the trading opportunities we'll be making money from later on. So simply put, our job as traders is to find areas of the market where we can enter a position at a certain price, have the price increase in our favor to another certain price, so we can then close our position and take our profit from the trade. Let's say that we were to enter a position here at $100. If price moved up $10 to $110 and we closed our position, we would be up 10% in profit. But let's dig one level deeper to really understand where these short-term trading opportunities actually originate. Let's talk about a classic investing approach, a buy and hold investment. Imagine you invest in the S&P 500. That is the index tracking the performance of 500 of America's largest and most powerful companies. Now, over a full 12-month period, just 1 year, what kind of returns can you typically expect? Well, in a solid year, you might see gains anywhere from 5%, 10%, 15%, or even 20% or more in some extreme cases. Now, in this case, in the last 12 months, you would have made 19.8% back on your investment if you had invested in the S&P 500 exactly 365 days ago. Now, here's where it gets interesting. What if we zoom into just this tiny section here? Instead of analyzing the entire year's worth of price movement, we're now examining individual trading sessions and daily price action. So taking today as an example, even within just this single day, we experienced this magnitude of downward movement and this amount of upward movement, amounting to a total of 1.2 to 1.3% in the down movement, as well as an almost 1% in the up movement, all in a period of a few hours. So rather than waiting 12 full months, if we could time our entries and exits accurately using the same risk amount, Just from this one move, we could generate substantial returns. This could all happen within a matter of hours, and we can potentially capture multiple opportunities like this within a single trading day. This is why trading is far more superior than any other major investment vehicle in the world, and nothing else comes remotely close to it. Now let's break down all the platforms and resources you're going to need to get this set up properly and begin your journey as a complete beginner. Now, you will without a doubt need TradingView for comprehensive chart analysis. Now, their basic free plan works great for starting out as well, which is pretty cool. Secondly, you will need a fully regulated brokerage trading exchange. This is where you will be opening and closing your trades, and it's also where your funds will be held securely. Now, I personally use Multibank as they are 100% fully regulated and very, very easy to use. I've been using them for almost 10 years and have withdrawn millions of dollars from my trading account with no problems. I never recommend using a broker that is not regulated ever. Now, you'll also need an easy to use risk calculator, which will help you figure out how much to risk on your trades based on your trading plan. I use the free MyFX book position size calculator. I've put the link in the description for you. Now, as for hardware, you'll need a reliable laptop or desktop computer, as trading on your phone can be very risky and it is not recommended. You'll also need a stable and preferably fast internet connection. Now, with your starting capital, you should only ever use funds that you can completely afford to lose. $500 to $1,000 represents a realistic minimum starting balance for Forex markets, and never, under any circumstances, trade with rent money or loan money. A few extra tools you should use when you're trading are the Forex Factory, which is extremely helpful. Now, the Forex Factory is a website which essentially serves as a central hub for Forex traders to access real-time market news as well as economic calendars. Its primary purpose is to help traders perform more accurate decisions when entering a position due to high impact news which cause significant price volatility. You would preferably also need a demo trading account for risk-free practice, which you can create using our broker as well. And ultimately, the most essential tool for truly mastering the financial markets is going to be the ability to master your own ego. The crucial point to remember in all of this is that you absolutely don't need to invest thousands into expensive equipment and software. I personally know successful traders pulling in 6-7 figure incomes using nothing more than a standard laptop. Remember that success comes from your strategy and your execution, not from your setup. Now, let's get completely clear on what we're actually trying to accomplish here, because this is an area where many beginners develop unrealistic expectations. Now, here are a few things that day trading is definitely not. It is definitely not some magical path to instant wealth, a guaranteed way to profit every single trading session, a form of entertainment or adrenaline-seeking activity, or a competition to outsmart other market participants. What day trading actually is: a professional skill requiring dedicated time to master properly, a method for generating steady income streams over extended periods of time, a disciplined business demanding patience and systematic execution, and a legitimate pathway to financial independence when approached correctly. Now, my personal methodology is straightforward and extremely effective. I target a 1-to-1 risk to reward ratio using high probability setups that any beginner can learn in a matter of days. This means that when I risk $5,000 on a trade, my profit target is also $5,000. Now, combined with my 81% win rate, this mathematical approach works exceptionally well over time and has done so for years. When you can consistently generate 1 to 3% returns on your winning trades, you are performing at an elite level. Now, it might not sound thrilling initially, but when you compound these returns over multiple years, you are looking at truly transformational wealth building and life-changing figures. All right, so now let's get into a lesson on trading psychology. Now, this is absolutely the most important section of this video, and this single factor will determine whether you succeed or fail in your trading career. Psychology destroys more trading accounts than any technical factor, so I need your complete attention here. Now, there are 2 account killing emotions. The first one is fear. Now, fear causes you to close profitable trades far too early out of panic, to skip perfectly valid trading setups due to hesitation, revenge trade after experiencing a loss, to constantly doubt your proven methodology, and to use position sizes that are too small when you should be confident. Now, greed is the second account killer. Greed causes you to hold losing positions way beyond your stop loss, use excessive position sizes that threaten your account, force trades when no valid opportunities exist, abandon your systematic approach for seemingly better setups, and risking too much capital when you should be exercising caution. Now, the solution, simply put, is this. You must execute trades with robotic precision and zero emotional involvement. Feelings and hunches have absolutely zero place in professional trading decisions. When your predetermined setup materializes, you execute the trade. When your stop loss level is reached, you exit without hesitation. No debates, no emotions, no exceptions under any circumstances. Now, here's my exact process for handling losing trades, and mastering this took years of discipline. Immediate acceptance. Zero frustration, anger, or disappointment if a trade loses. Objective trade review. Was this a valid setup that simply just didn't work out? If valid, move forward immediately. If flawed, extract the lesson and improve from it. And absolutely never engage in revenge trading, because this destroys accounts instantly. I cannot tell you how many accounts I blew when I first started trading due to revenge trading. My non-negotiable discipline structure. Establish these rules and follow them without exception. A maximum risk per individual trade rule is a must. I never personally risk more than 1 to 3% of my total balance per trade. A daily trade limit is where I stop trading after 3 trades regardless of outcomes. A loss limit protocol means I immediately stop trading after 2 consecutive losses to protect my mindset. And I only trade during specific scheduled trading times. Example, 5 to 10 p.m., 9 a.m. to 3 p.m., or specific sessions. Now, this is the silent account killer. It is one of the most common and expensive psychological traps in trading and investing. FOMO describes the intense anxiety or regret you feel when you see the price of a stock or asset moving strongly in one direction, usually exploding upward, and you believe you're missing out on easy profits that everyone else is making. Now, FOMO destroys more trading careers than any other psychological factor. You witness a significant price movement and think, I should have been in that trade. So you enter it late. You go against your trading plan and you blow your entire account because you're trading without a sharp mind. This mindset will ruin you completely, and you will never become profitable if you cannot overcome this. Now, the market provides endless opportunities every single day. It always does. I would rather miss 10 potentially profitable trades than execute one poorly planned trade. Your account balance will reflect this conservative approach positively over a longer period of time, I can guarantee it. Now, one thing you need to understand if you want to be a profitable trader is that losing trades is completely normal and it is part of the game. If any trader tells you that they never lose trades, they are completely lying. It is healthy to lose trades so you can learn from your mistakes. And sometimes when you enter a position and you lose a trade, it's not that you actually made a mistake, it's just that the market didn't go where it was supposed to go. And that happens all the time, every single day. You need to think about it from a long-term perspective. Don't have recency bias. Recency bias is where you lose a couple trades and you think that that determines the overall structure or record of your trading strategy. Now, as you can see here from this diagram, if we were to take 15 trades on a 1-to-1 risk versus reward, and we were to win 9 trades and lose 6, we would simply be 9% in profit minus the 6% that we'd lost, meaning we would still be at a 3% profit. Now, keep in mind that the banks only give you 3 to 4% per year on your money that you keep in there. So if you can go and take 15 trades in a week or in a month and win 9 and lose 6 and follow a 1-to-1 risk versus reward, you will make more money than what the bank gives billions of people every single year. You would have made it in a week or a month. Now, it's very important to understand this. Markets operate on their own timeline, completely independent of your personal financial needs, your emotional state, or your desired schedule or outcome. Price moves when market forces dictate, and your responsibility is to wait patiently for optimal opportunities and execute when they present themselves. Some weeks I only execute 2 to 3 trades total, and certain weeks I don't trade at all. This is perfectly acceptable because my goal isn't trading activity for its own sake. My goal is consistent profitability over extended periods of time. Now, for trading success, one broker I've stuck with for years and really recommend is Multibank. They're well regulated, so I feel totally secure with my funds. There's no hidden fees, tight spreads, often starting from 0 pips on an ECN account, super fast execution, and they handle massive daily volumes, often over 35 billion US dollars which shows the trust that they have from traders worldwide. So if you're after a reliable broker, check them out via the link in the description. Now that we've nailed the position building framework and the non-negotiable risk control rules, as well as a full crash course on the most important aspect of trading being psychology, I want to quickly show you what a candle is and what each candle represents. So essentially in the market, we either have a bullish candlestick or a bearish candlestick. A bullish candlestick means that price is going up, and a bearish candlestick means that price is going down. What this top part here means is price at some given point during the time frame of this candle has reached this price. It also means that at some point during this time frame, price also potentially reached the bottom of this candle. This is what we call a wick. This is what we call a body of a candle. What this candle truly represents is that price opened in the time frame at this level, and at some point throughout the entire time frame of the candle, it hit this price, but it closed at this level. Because it opened here and it closed here, it is called a bullish candle because the value of price moved up. Now it is the same thing with a bearish candle. Price opened here at some point during the time frame, it moved up to here, then it shot down to here potentially, but it closed here. Like we said before, this is a wick and this is the body. That's all you really need to know about candles as of this point. Now, technical analysis has endless noise. I've cut it down to just the 4 or 5 core elements I use to spot the highest probability entries. Now, before we dive in, remember, none of this works without the psychology that we've already drilled in. Mastering FOMO, killing revenge trades, staying detached from single outcomes, accepting missed moves, protecting your capital over your ego, cutting losers fast, and letting winners run, that mental edge is what turns good technicals into real results. Now, without psychology and a clear mind, even 90% winning strategies will lose. Now, I go way deeper into the full strategy on my channel and in my private mentorship. The exact setups, entries, exits, risk rules, trading plans, and everything that's helped me build millions in real markets. If you're serious about leveling up and trading like this consistently, make sure you check out those in-depth breakdowns on my channel. I'll also drop cards and links at the end of this video so you can jump straight in and start applying it yourself in real time. Now, with that foundation locked in, let's open TradingView and walk through a very basic lesson of what I look for when I enter a trade. Now, I'm going to keep this incredibly straightforward because most people massively overcomplicate these concepts and then completely derails their progress. Now, whenever I open a chart, first I choose which pair I want to analyze. So right now, I'm going to be analyzing the Australian dollar versus the Japanese yen. Now, I've got my chart open here, and the first thing that I want to look at is what trend is it in. So what I use is a ray line. All you do is you go from the lowest point of the chart, you try to find somewhere where price has touched multiple times, and you draw a line. As you can see, we are in a clear uptrend. Uptrend meaning because the price is above the line and it has been trending up since 20th of October, 2025. What you don't want to do as a beginner trader is ever open a long-term position selling meaning you're hoping the price is going to go down on the higher time frame. You are trading against the trend in that regard. Number one lesson that anyone in trading can give you is never trade against the trend unless you are a highly skilled professional and you've proven to be profitable over a long period of time. Counter trend trading is very, very risky, and I barely even do it myself. The next thing that I like to do is draw out basic support and resistance. Now, just to break it down for you in very simple terms, support is the level below price. It's the level that kind of acts like a floor. Price will usually tend to touch this level multiple times. We can clearly distinguish it as a level of support. So what you're going to want to do, you're going to want to go to where price is. You're going to want to go below and try to draw a line where you see multiple touches of the line. The next thing you're going to do is you're going to want to draw a level of resistance. Now, to find the level of resistance, all you're going to want to do is go on your tools, click on the horizontal line, and draw a line at the highest point that price has reached. Keep in mind that AUDJPY is currently breaking all-time highs, meaning price has never reached this level before. So this is all we have in regards to looking for a level of resistance. This right here is now our level of support, and this right here is now our level of resistance. Given that we are in a clear uptrend, you would never really want to open a position hoping that price will ever go down, because most of the time when you trade against the trend, you will have a negative win rate. As you can see at this level here, price has been here multiple times and respected it. So what we're going to do here is we're going to draw another level of support. This is going to act like a floor for us, another level of protection. As you can see, when price kept coming back to this level of support, it kept bouncing off and it respected it and then it shot back up. If you had a strategy and you had entered at this level of support right here and you risked this amount here, you put your stop loss at this level and you rode the trade all the way to where it is right now, you would have been able to make a 1 to 4 risk versus reward. So if you had put $5,000 on this trade to risk, you could have made well over $20,000 in profit. Now, the single most powerful indicator in all of TradingView, in my opinion, is the Fibonacci retracement tool. Now, the Fibonacci retracement tool represents my ultimate trading weapon, and it is what's generated my 81% win rate across years of consistent trading with millions of dollars in profit. Now, while other traders clutter their screens with dozens of different indicators, I use Fibonacci retracements to pinpoint high probability price reversal zones with insane accuracy, optimal entry points with favorable risk to reward ratios, and logical profit taking areas based on mathematical relationships. Let me show you how this works in real time. Now, to access the Fibonacci retracement tool, all you're gonna have to do is go to this left bar here, click on this level, press on Fib retracement. When you touch once, it will start the tool, and when you touch again, it will draw the tool. Now you can move it whichever way you like. As you can see, we are in a clear downtrend, okay? So all you're gonna do is you're gonna wait for the pullback. You're gonna draw it from the pullback all the way to the next low, which is right here. And as you can see, if you were here and you waited for this moment, all you do is you draw from the high to the low, you wait for this pullback that's occurring right now, you put your entry at this level. This is called the 0.5 or the 50 fib level. Price tends to always come back to this 50 fib level before it continues on with the move. You would have had a sell order here, a sell order meaning you would have entered the market in hopes that price would continue going down. You would have put your stop loss at the level 1, and you would have put your take profit at the level 0. All this means is if you entered at the 0.5 fib, from the 0.5 all the way to the 1, as opposed to the 0.5 all the way to the 0, it is the exact same distance, which is how I trade with a 1-to-1 risk versus reward every single time. I always enter off the 0.5, but you can also enter off the 0.618 as well. The 0.5 to the 0.618 area is called the golden zone. When price comes here, it usually continues on the same way it was moving before the pullback, which is what gives us high probability setups and has been working in the markets for over 50 years. As you can see here clearly, price moved down, it retraced back up to the 0.5 fib. You would have entered here, you would have instantly gone into profit, and your trade would have closed here in profit. You can essentially continue this the entire trend until you end up losing a trade. So what you would do is you'd go here, you draw it at the pullback, you'd find the next low, you'd enter off the 0.5. In this specific trade, you would have gone into a bit of drawdown. You would have waited for price to go here. You would have entered the market as soon as price hit the 0.5 fib. And as you can see, you would have gone straight down. You would have hit your take profit at this level. Bang, there's 2 easy trades. Now this works in the markets. It works on every time frame, but I highly recommend if you're just starting out as a trader to do this only on the 1 hour time frame and above. The reason I say that is because the 1 hour time frame and above is highly accurate, especially with this strategy. And your win rate will go down the lower time frame you trade on. It will still be profitable even on the 1 minute time frame. If you're learning to trade, you do not want that much volatility. It will mess with your head. Now, the vast majority of traders make trading far more complicated than necessary. If you just maintain simplicity and focus on effectiveness, you'll outperform 95% of other traders. Now, let's get into your trading plan. Your trading plan serves as your complete roadmap to consistent profitability. Without this foundation, you are essentially gambling with your capital and hoping for profitable outcomes that never come. To calculate your position size, it's going to be very, very straightforward. All we're going to do is we're going to go to the position size calculator on my FX book. You're going to put in the currency pair that we're trading, which is clearly Euro USD. You're going to choose your account currency. I trade in US dollars. And let's just say we're going to enter this position right here. Okay. Very straightforward. I'm looking at selling here, which means I'm looking at price going down. So all I'm going to want to do, I'm going to open this tool here. It's called the short position. I'm going to enter off the 50 fib, which is right here. I'm going to put this, you can literally just drag this up and down. This shows you where your stop loss is going to be, and this shows you where your profit's going to be. Do it like that. Now, what you're going to want to do next is this number here where it says 57.2. that is your pip value. I cover pip value on another video on my channel, so make sure you watch that. It is very, very important. We're gonna put in a $10,000 account balance, just for an example. We're gonna say that we're gonna risk 2% on this trade. Our stop loss is going to be 57.2 pips. You're gonna leave this trade size on 1 and you're gonna press calculate. So to maintain a 2% risk on this trade, to risk $200 from a $10,000 account balance, you're gonna have to open 0.35 lots when you enter your position. And it's as simple as that. So we're gonna go over to the Forex Factory. And what you're gonna wanna do is you're gonna wanna press on this little setting button here. You're gonna wanna tick the red and tick the orange, and you're gonna leave the yellow and the silver. Now you're gonna press back on the setting to close it. Like I said before, I'm from Australia, so any major news relating to USD, it usually occurs late at night for me. As you can see here at 12:30 a.m., we have a red folder impact news, and we have 2 USD impact news. Now, when you see red folders like this, core PPI, GDP, PPI, all that means is that there's gonna be quite a bit of volatility in the markets at this time. Now, if you're from America, this is usually the same time when the banks open, which is usually 9:30 a.m. Forex Factory will automatically put your time zone in, so you don't have to worry about changing this. If your trading plan tells you not to trade 2 hours before or 2 hours after, this means that you should not be in any trades 10:30 p.m. onwards or 2:30 a.m. or before. So 2 hours before the news or 2 hours after, because price volatility when there's red folder news throws all technical analysis out the window. So the ultimate trading plan framework. You need to answer these questions. Which specific pairs will you be trading? Will it be GBP USD? Will it be gold? Will it be silver? Will it be the stock market? Will it be indices? You have to decide. I personally trade Forex and sometimes gold. Gold is very volatile, so for beginners, I highly recommend you stay away from it. I recommend sticking to pairs such as GBP USD, GBP JPY, USD JPY, Euro USD, and so on. The major pairs always seem to have more consistency with a strategy like mine. Now, which exact time periods or sessions will you actively trade in? So me personally, I trade during the Euro session. So because I'm from Australia, the Euro session is usually between 6 p.m. to 11 p.m. If you're from the UK or the US and so on, you could essentially just trade the New York session, which is usually in the morning. How much are you going to risk per position? Is it going to be 1%, 2%, 5%? Like I said before, I never risk more than 3% on a trade, no matter how confident I am. Now, what is your daily loss limit percentage wise before you stop trading for that day? Are you going to say to yourself, if I lose 7%, I'm done. If I lose 4%, I'm done. Make a decision and stick to it. What must occur on the chart before you enter a position? Think hard, think about your strategy, and only follow that. Don't make exceptions in the heat of the moment, and do not let your emotions take control. Now, what risk versus reward factor are you aiming for each trade? Is it going to be a 1-to-1, a 1-to-2, a 1-to-5? You decide. If you're going to use my strategy yet again, it is going to be either a 1-to-1 or a 1-to-1.6, depending on whether you enter off the 50 fib or the 61.8 fib. And very, very important, what time frame will you be trading on? Like I said, for beginners, I highly recommend trading at least the 1 hour or above, which would be the 1 hour, the 4 hour, or even the daily. If you want trades to open and close within the same day or 2 or 3 day period, then the 1 or the 4 hour is fine. You can also trade the 30-minute as well if you really want. Now, some important do nots. Do not trade 1 to 2 hours before or after any red folder news. Do not set a profit target for the day, the week, or the month ever. Do not revenge trade. Do not give into FOMO. Do not ignore proper risk management parameters. Do not let emotions drive your decisions. Do not overtrade, and do not adjust your stop loss if your trade is going against you. That is one of the worst things you can do for your mind. And remember, you must journal every trade that you take. This helps you stay accountable. You can write your answers to the following questions if you like. What was my exact thought process and rationale before entering this trade? Did I manage risk and position sizing correctly according to my rules? How did emotions or mindset influence this trade during entry, management, or exit? What did I do well in this trade, and what could I have done better? What patterns or lessons emerge when I compare this trade to others? Use this simple trading plan framework, write out your trading plan, and before you enter a trade, make sure you read this multiple times. It is going to be the main driver which decides whether you become profitable or if you're going to lose all of your money in the markets like 97, 98% of everyone else. Now, implementation and skill development. Now, phase one will be intensive education for at least 2 to 4 weeks. Analyze charts daily without any exceptions. Practice drawing Fibonacci levels on historical price data by using the bar replay feature on TradingView. Identify trend patterns and potential setups using past market movements. And do not use any real money during this phase. This is absolutely critical. Phase two is going to be your demo trading mastery, which you will do for at least 4 weeks, but 8 weeks is highly preferred. You would need to open a demo account with your selected broker. You would execute your strategy using simulated and fake capital only, no real money yet. You will document every single trade in detailed journal format, and you will continuously refine your approach based on your documented results. Now, the more backtesting that you do, the more solidified your results will be and the more accurate they will be, which means less surprises when you start trading with real capital. Phase three is going to be your live trading transition. This is going to be an ongoing development that you will keep perfecting over the years to come. You will begin with an absolute minimum position size, which would essentially be 0.01 lot. You would focus entirely on plan execution and rule following while ignoring profit targets. You will build confidence gradually through consistent, successful execution of a trade. And you will increase position sizes only after a few months of consistent profitability. All right, we've covered an enormous amount of material today. Let me summarize the most critical points that will determine your ultimate success or failure. Remember to master the fundamentals. Trading revolves around supply and demand imbalances. Maintain your tool simplicity. Remember that expensive equipment does not create trading success, your mind does. Psychology dominates everything. It's either emotional control or account destruction. Focus on core concepts, trends, support and resistance, Fibonacci retracements. Develop and follow your trading plan religiously, with 0 exceptions permitted, and practice extensively before risking real capital. So demo trade until you are consistently profitable. Now remember, everyone claims you need dozens of indicators and complex analysis to succeed in day trading. But I've demonstrated that Fibonacci retracements on higher timeframes combined with proper risk management delivers superior results. This approach has maintained an 81% win rate for years. Now, trading success isn't about being correct constantly. It's about generating profits consistently over time using a simple, repeatable methodology. With proper mindset, disciplined risk management, and a straightforward strategy like I've outlined for you today, you can avoid the years of confusion and thousands in losses that I've already experienced. If this content provided value for you, please definitely hit that like button, subscribe for more educational content like this, and comment below with specific topics you'd like me to make a new video about. The markets operate continuously, so invest time in proper education, master these concepts thoroughly, and execute intelligently. And I'll see you in the next video.